Newsflash, your worst enemy is not inflation, it's not deflation, it's not a market crash, or whatever the scary financial scenarios you can dream up of. Rather, we ourselves in many cases become our own worst enemies. And in this episode, we're going to examine common biases that may be tripping, trapping, and hindering your investment progress. The field of behavioral finance has given us valuable data on the human psyche. It attempts to explain and understand why we behave the way we do with our money. People in standard finance are rational. People in behavioral finance are normal, explains Meyer Statman, PhD and researcher at Santa Clara University. So what behavioral biases are messing you up and disturbing your financial plan? Well, let's examine a few common problem areas that afflict the investing masses. So we'll start with what's called a loss aversion bias. Now, this bias was first identified back in 1979 by Daniel Kahneman and Amos Tversky. And through research studies, they discovered that people tend to feel stronger about avoiding investment losses compared to achieving investment gains. As a result, people will often hold on to their losing investments, hoping that they'll return back to break-even status. Next up is hindsight bias. This particular fault occurs when people become so infatuated with past events that they falsely conclude that it's going to predict the future. For example, let's say a certain stock or mutual fund or ETF has performed very well in recent past. Well, the tendency is to believe that that same performance is going to repeat itself into the future. See, part of the problem with the hindsight bias is that people tend to have selective memories. And when they examine the past, they often fill those memory gaps with what they prefer to believe or what they remember rather than focusing on reality. Let's move on to the overconfidence bias. This flaw happens when people overestimate their own knowledge, their own talent, their own abilities. For example, a person that buys a stock or ETF or another investment that shoots up substantially in value may attribute those gains to themselves rather than to other factors like luck or some other related factor. Now, the pitfalls of overconfidence end up being that people will underestimate financial risk and hold poorly constructed portfolios that lack diversification, and also people trade excessively when they're overconfident. Like Icarus, who flew too close to the sun and fell, the overconfident investor, in time enough, comes crashing back to the earth. Next, we have the regret aversion bias. What happens when people, out of fear, avoid making financial decisions because they're afraid that it might turn out bad? What happens? Well, they do that because they've been snake bitten by regret aversion bias. Simply put, people are attempting to avoid the pain of regret that comes with poor decisions. Now, this particular bias may cause people to be overly conservative with their investments, especially if they suffered steep losses from risky investments in the past. Finally, there's the status quo bias, which is all about doing nothing, which some of us are good at doing. It's all about maintaining the status quo. It happens when people fail to explore new alternatives or new opportunities, or when people unknowingly maintain suboptimal portfolios. Instead of making changes to fix the apparent problems, what do? The investor with status quo bias prefers to avoid making any choices by sticking with what's familiar. So in summary, each of us has behavioral tendencies that can be both good and bad. And at any given time, our behavior simply amplifies whatever bad things might be happening around us. So what behavioral glitches do you have that might be threatening your well-being? In the end, self-awareness can go a very long way towards avoiding the pitfalls of financially destructive behavior. I'm Ron DeLegge with ETF Guide. Thanks for watching.